Every office building, warehouse, and retail space you see is likely tracked, priced, and traded using data from one company, CoStar Group. They sit on a $40 billion valuation, quietly controlling roughly 80% of the commercial real estate information market. But right now, the foundation of this quiet monopoly is cracking under the weight of a massive rebellion. Billionaire activist hedge funds have launched a hostile campaign against the company, demanding immediate board shakeups and threatening to dismantle its latest multi-billion-dollar project. Andy Florance founded CoStar nearly 4 decades ago, taking it from a dorm room startup to a multi-billion-dollar NASDAQ staple. Now he's fighting to keep control of the board he spent his entire life assembling. To understand why Wall Street heavyweights are suddenly trying to tear the wheel from his hands, we have to look at how this data monopoly was constructed in the first place. Back in 1986, the commercial real estate market operated in the dark ages. While Wall Street traders were looking at electronic screens, property brokers were entirely reliant on paper records, printed directories, and word of mouth to figure out what a building was actually worth. Working out of his Princeton dorm room, Florance saw an obvious gap. He realized the property market needed a centralized, digitized database. He wanted to build the equivalent of a Bloomberg terminal, but for real estate. His team started manually digitizing millions of property records. By the early 1990s, they were physically distributing this massive cache of market data to brokers in major cities using floppy disks. By 1998, this data collection became the foundation of their IPO. They aggregated the scattered records, brought them online, and locked them behind a high-margin subscription paywall. If a broker wanted to compete, they had to pay CoStar for access. Armed with public capital, Florance shifted tactics. He pivoted from slow organic expansion to a predatory strategy, identifying established competitors and simply buying them out. They secured absolute dominance in commercial property listings by purchasing LoopNet for $860 million. 2 years later, they grabbed Apartments.com for $585 million, expanding their grip into multifamily rentals. This chart shows CoStar's relentless streak of over 55 consecutive quarters of double-digit revenue growth. These acquisitions eliminated alternatives. By absorbing the competition, CoStar trapped brokers inside its ecosystem, leaving them no choice but to pay whatever rates the company dictated. Maintaining that kind of market control requires an aggressive corporate culture. CoStar developed a reputation for strictly defending its turf, relying heavily on the legal system to neutralize threats. The company has a long history of filing massive copyright infringement lawsuits against rivals. They've targeted competitors like Crexi and even residential giant Zillow, accusing them of stealing tens of thousands of proprietary property photos from the CoStar database. This approach triggered intense industry backlash. Commercial brokers recently filed a nationwide antitrust class action lawsuit. They allege CoStar wields its massive market share power to enforce restrictive contracts, stifle new innovation, and artificially inflate prices. Win or lose in court, weaponizing the legal system functions as an almost impenetrable corporate moat for the company. The sheer cost of fighting CoStar drains a competitor's resources long before they can ever scale up to challenge the monopoly. Operating from their headquarters in Arlington, Virginia, Florance set his sights on the final frontier of property data, the massive residential real estate market. CoStar acquired the massive residential portal, Homes.com. To guarantee its success, management committed to spending a staggering $1 billion to unseat Zillow and take the top spot. They unleashed an aggressive mainstream marketing blitz, hiring A-list celebrities for premium Super Bowl commercial campaigns designed to flood the market with brand awareness. This chart tracks CoStar's adjusted EBITDA margin, a key measure of operating profit. Watch the margins plummet from historical levels above 30% down to 13% due to heavy marketing spend. This massive cash burn triggered immediate panic on Wall Street. That panic opened the door for activist hedge funds D.E. Shaw and Third Point to launch their rebellion. The funds publicly labeled Homes.com a money pit, as billions in spending generated minimal revenue. They demanded immediate board shakeups and pushed CoStar to divest the residential platform entirely. To appease angry shareholders and protect his control, Florance and the board authorized a massive $1.5 billion share buyback program while actively refreshing the board's independent directors. Management also promised to slash their net investment in Homes.com by more than $300 million in 2026. The goal is to prove to the market that the residential platform has a clear mathematical path to breaking even. The year 2026 will serve as the ultimate test. Florance must prove Thang's aggressive playbook works just as well in the residential space, or risk watching the empire he built crumble from within.